but those larger organizations have a very different business model than we do. So I don't necessarily look at them as competitors. Obviously, they have a pulse on what's going on in the economy at a much higher level. But as far as being able to serve our clients, I think we do a very good job of doing so without really being concerned about some of the larger players.
Anyone paying attention to venture funding over the past few years would think fintech was completely taking over every facet of banking and finance. However, the actual users of traditional banking are today entrusting those regulated institutions with over 23 trillion of their dollars, an increase of more than 30% in the past 5 years. With us today to discuss the resilience of retail banking is Elizabeth Magennis. Elizabeth is the president of ConnectOne Bank. ConnectOne is a $9 billion institution started in 2005 and serves the New York, New Jersey metro area in Florida. Elizabeth, thanks for being here today.
Thank you, Rich, for having me.
So I think it's probably worth talking about like the unique perspective you bring in that ConnectOne was started in 2005, correct?
Yes, that is correct. It was started in 2005 by Frank Sorrentino, who is our chairman and CEO, and a number of business people in the community that saw a need for true community banking to serve small to mid-sized businesses. And obviously, we have other products as well to help all those consumers in our market as well. But that was the main focus, was that the founders felt that there was nowhere for a small to mid-sized business to go into a banking institution and actually have conversations with real life people about possible concerns or problems or financing needs or banking in general as an advisory service, and have the ability to actually speak to people who could make decisions.
That, of course, that was maybe fortunate or unfortunate timing in that you had what, 3.5 years before running headlong into the great financial crisis. That how did that shape maybe the history or your approach or strategy or your view of the market?
Believe it or not, it was an opportunity for us as a small, nimble bank to be able to bring on clients that were being discarded by much larger institutions, because some of those larger institutions decided that they were not going to be involved in some business lines, like construction, for example. We've always had a construction portfolio that is Frank Sorrentino's background. He's an entrepreneur. He was in the construction business. So we always understood the needs of that particular business. And during 2008 to 2010, they were, larger institutions were not even discussing it. It was sort of with a broad brush. They just said, no more construction lending. And that gave us the ability to get in front of clients and really explain our value to them as having the ability to sit down with somebody, a decision maker, to help them get through that time.
So is that continue to be like an anchor of your business today, or is it
Well, it's
kind
a
of
part of it. It's a
sure?
part of it. We do a lot of commercial real estate, but we have different, different asset classes that we focus on. I mean, we have commercial real estate, we have construction lending, healthcare lending, SBA lending. We're always partnering with different venture firms. So we bought a company by the name of Bowfly a couple of years ago that focuses on helping franchises actually get loans and do some verification process for some of those franchisees. So we dabble in everything.
So, but your portfolio goes both between business and consumer, correct? From
Correct.
what you do. Okay.
That-
What's roughly the split there from how you manage that?
I would say the majority of our portfolio is for business owners, either in the commercial real estate space or in commercial and industrial space. But we have a small portfolio of consumer, just because our business owners also have either borrowing needs or depository needs. So we offer that as well, but it's a very small portion of what we do day to day.
So, given the history there, like really, how is your business changed like in the past 10 years? Because you started in a very different environment than you find yourself today, having gone through now, depending on how you want to clock it up, two major, economic downturns plus a once in a lifetime kind of regulatory process that dragged on for years.
It's been interesting. It's been challenging, but within challenging times, there also lies opportunity. So that's the way we like to look at it. We consider ourselves a pretty gritty, you know, centered, crucial for the community. We are in New Jersey, New York, and Florida. Basically, what we've done is we've listened to our clients and been able to pivot and shift as needed to be able to meet some of the demands and their needs. And a lot of that has to do with our organization not being that big. So we only have 24 locations. We only have about 500 people for an institution of our size. So you can get things done pretty quickly and you can make decisions pretty quickly, whether it be a yes or a no or an alternative route to whatever the client may need or want.
So how is the change of, your predominantly business, small business and construction company, how is their needs changed? Like how is that affecting your strategy or kind of where you're going with where ConnectOne's going and the approach you're taking to your offerings?
Yeah, that's a great question, Rich. A lot of our clients now have pretty much come to us more in an advisory capacity, whether or not they should do a certain project, whether or not the math works, what's going to happen in the future. In our particular geography, there's still a huge housing demand, and people still need housing. But if the numbers don't work based on what the cost of the material is and what the cost of the land is and what the cost of labor are, a lot of people are waiting to see what happens. We talk to all sorts of businesses every single day to try to help them understand what lays ahead for the future. But we've had other instances where clients have an opportunity maybe to buy another company because, there might be a company for sale or, it's generational and they decided that, the second or third generation wants to sell the business. So, here we are helping those clients through our relationships with them, right? So we're a relationship bank. We are not a transaction bank. So what does that mean? That means you have your depository accounts with us, you have your lending with us, you have your account, your personal accounts, your children's accounts. We consider ourselves a community bank for a reason. And I think what's so important is not losing that touch and relationship with the client and being there in their time of need.
So, we're kind of a year and a couple of quarters out from, the kind of the big scare with regionals last year. And, a number of the guests that we've talked to have kind of said, yeah, it was a thing, but it really didn't impact their retention very much, that they kind of saw very much a resilience in both the relational aspects of what they did, but also their balance sheet. And that broadly played out. If you kind of look at a lot of analysts, they saw, that sub 10 billion class of financial institution, bank and credit union really did not see an asset flee very much, in the past year. Has that been true for you? And I think there's very much a regional aspect to this from kind of where you play and the markets you serve.
Absolutely. I will tell you, it was comforting to hear from our clients when, the events of March 23 happened, basically saying, well, we're not worried about you. We know the bank. We know that you are solid. We've seen your numbers. But we still wanted to offer our clients the ability to secure their deposits. We had a product that we offered that we always had. It was called ICS, so where you could insure your deposits over $250,000. We always had that product even before the crisis for some of our large private schools business that we had. So if a client felt better about moving funds into that product, we were there to do that. So we did offer them the ability to do that. And I think that just brought a lot of tense moments to a halt. I think the messaging that we sent to our clients was We didn't say, oh, don't worry, we're safe. We didn't say, hey, don't worry about us. What we said is, we're here for you. So, whatever that may mean for you, we're here to serve your needs. And having that ICS product was one way that we demonstrated that.
So one of the other things, and again, there's a heavy regional aspect to this, is around the concern of the CRE portfolio that's sitting on the balance sheets of many banks. Like, and I we never get like a really consistent answer either from analysts or from the Fed or anybody else. But what's your view, being much closer to this? Is this really a ticking time bomb for the banking sector, or is it much more of a kind of regionalized mixed bag?
I I think it really depends on the portfolio of the bank itself, what bank you're talking about. I CRE is a very big pool, right? So there's a lot of segments that make up CRE. So I think a lot of the headlines revolved around New York City office, right? So what's going to happen to those, because they're seeing vacancies in, older buildings in Midtown Manhattan. Well, I will tell you, probably most community banks didn't do those types of loans, right? They didn't do, 50, $100 million loans. That was probably a lot of private lenders that did that, or maybe some of the larger institutions. So that's making the headlines, but it doesn't mean that everyone has that, right? So multifamily is another segment. And then there's the rent stabilized portion of the multifamily. Not every bank has that. Some we have office in our portfolio, but a lot of that is suburban small office. And what do you consider office? It could be a dentist office. It could be a doctor's office. So, I grin when you say that CRE portfolio, because it means so much. And I think a lot of people outside of banking don't understand that, especially as a consumer, right? You're watching the news and you're hearing about this and you're saying to yourself, oh my goodness, is this something that I have to worry about my bank, if they're involved in commercial real estate? And the answer is, maybe it depends on the bank and what they have in their portfolio. But it'll be interesting to see what happens in the next few years.
So one aspect of you is you are almost quite literally in the shadow of Wall Street and the biggest banks in the world. How much does that play? I mean, just like the physical proximity and the people that you, how much does that play into like your competition, your competitive positioning, how you think about that?
So, listen, I have a lot of respect for some of the leaders of those larger organizations, but those larger organizations have a very different business model than we do. So, I don't necessarily look at them as competitors. I actually think that there's a lot to be learned from some of those larger institutions. I mean, obviously, they have a pulse on what's going on in the economy at a much higher level. But as far as being able to serve our clients, I think we do a very good job of doing so without really being concerned about some of the larger players.
So is that more from like a brand standpoint, just like, hey, here's somebody that would or would not do business with me, or is it more tangible aspects of your business model?
It's interesting because there have been clients that we've come up against, or new prospects, I should say, that we've come up against, that had opportunities to go with larger institutions for whatever their needs were, and they ended up choosing us. And the recurring theme of why they chose us over those larger institutions was that we were able to react a lot quicker. We were able to say yes or no a lot quicker. And that was the decision that they made, because they said, that's more important to us, being able to speak to a person, know who we're talking to. Someone shows up at my office, I can pick up the phone, I can reach someone, versus maybe dealing with a larger institution where they can't be as quick to make a decision. So I think that gives us an edge.
Now, the other big boogeyman that we kind of talked about in the intro is fintech, right? Thinking about neobanks and just straight up unregulated institutions that are doing, quote, banking. How have you seen that as competition, or affecting your business, or maybe even affecting how you're positioning yourself?
It's interesting. I think about it. Some days I think about it a lot, and some days I don't think about it at all because a lot of times in the news, you're seeing that people are affected by some of these, I'll call them loosely institutions, that bank consumers, and they find out that maybe it's not so great. I always preach to my kids, make sure whatever, of course, they bank with ConnectOne, but whatever banking institution you're with is FDIC insured, right? So there's a reason why you pay for that charter, right? So that you have that assurance that your money is safe. So I think that they play a role. I think as time goes on, I think they'll need banks a little bit more. And I think that it will change as time goes on. I think especially since this crisis, people probably have figured out that it's important to deal with a real bank that understands what it is that you need and that you can call in a time of need. When you have a problem, right? I always tell people when everything's fine and everything's running smoothly, it's not an issue. But the minute you have a problem or, you have fraud or you have something, okay, who are you going to talk to? Can you pick up the phone and say, I know this person's going to respond to me or this person's going to actually pick up my call?
Now, somewhat tangential to that, and you mentioned you have 28 branches
24
right now.
locations.
24,
Yeah.
24. Um, that that can be a kind of divisive or controversial decision about whether to kind of keep or maintain locations, particularly when you're looking at like competitive investment case around digital experience, trying to ramp up like DAO and things like that. Like how do you maybe balance those priorities and continue to make the case of having a physical presence in the communities we serve is worthwhile or necessary?
I do think there is a necessity for physical locations, even from a psychological aspect, for people. Humans like to deal with humans, and if they see a building with ConnectOne Bank on it, they're like, okay, it's a real company. It really does exist. And I think what we've done, so in 2005, the biggest decision that we had to make around technology was whether or not we should have online banking. And so look how the world has changed. Even during COVID, we were so quick to change into a hybrid model, both internally and externally. We had the capability to still serve our clients, even though we had all the COVID restrictions in place. And people became more comfortable with using the technology that was available to them. So I think we will continue to have that hybrid model as time goes on. Whenever we consider a location, we're considering the client's needs at those in those particular geographies or footprints. So, for example, most of our offices are dual capacity, right? So it's not just somebody taking a deposit or giving you cash. There are advisory services. There may be a lending team in those locations. There may be underwriters in those locations. So it's really a mix of people to be able to sit down with a client and really have a conversation. And I think going forward, that's going to continue to be our model. And we're in the process of opening a branch right now out on Long Island, and because there's a need for it in that particular market. So I don't think I don't think it's necessarily going to diminish. I think it's just going to change.
So how much do demographics play into this? Either from the standpoint of it, you kind of have this footprint that's urban, exurban, suburban, plus very changing demographics from an age standpoint in your area. How much does that affect your approach, whether it's just branch design or the how you handle your product management and your product flow from what you're doing?
Yeah, we definitely all of our branches are a little bit different depending on where they're located and what the demographic need is. And like you said, there is a generational change. But what's happening is a lot of our older clients are now passing on their businesses to either their sons or daughters or the next generation. And now that generation has recognized the value of having a banking relationship and being able to pick up the phone. So I think demographic does play a role. I mean, for us, it's more about serving the client than it is to say on a piece of paper whether or not it's, how much money are we going to make in this particular branch if we open it in, X location. So it's really about the need. And we've always followed our clients. It's been something that we've always done. We started in New Jersey, and a lot of our clients were doing business in New York City, so we opened an office in New York City. And then a lot of our clients were making investments and investing in the Florida market, so we opened an office in Florida. So it really is this sort of thread that we take through our clients and really think about, okay, where can we have the most impact?
Well, Elizabeth, thank you very much for sharing your kind of unique perspective on this. Particularly, you start thinking about, community bank. Nobody thinks New York City, right, when they come to that.
Right.
So thank you for sharing very much. If anybody wants to learn more about you or ConnectOne, where can they go?
ConnectOneBank.com.
Great. We'll put a link to that in the show notes. Elizabeth, thanks again for being here.
Thank you, Rich.